All right. Welcome back to the Roadmap to Retirement podcast. Delighted to be joined by Yitzchak, which I know I said that wrong, so go ahead and introduce yourself and I'll let you do a better job.
This is Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement.
Sure. Hi, my name is Yitzchak Eilenberg, a CPA, and I focus on tax strategy, tax planning, tax preparation, and always looking for different ways and strategies to help maximize tax savings for all of you. So how about you go ahead, Alex, and give some questions and scenarios and situations or anything you want to cover, and we could start unpacking a lot of cool ideas, these different items.
Yeah, we appreciate you being here. So I came across your stuff on LinkedIn probably a few months ago, and you do a great job of posting insightful, helpful content, which is aimed mostly at helping small business owners take advantages of all the opportunities that exist in the IRS tax code. And I think to preface this conversation, a lot of people who start businesses, they get into it because they have a passion, right? They have something that they like to make or a service that they offer, and they decide to make a career out of that. And then sometime down the road, this hobby becomes a business and they start making money, but they a lot of times don't ever approach it from a financial standpoint or a tax standpoint. And there's a lot of things that they can be doing differently to save on taxes. And we always want to focus on tax avoidance, not tax evasion is illegal, but we want to find as many legal ways as possible to pay less taxes. That's what business owners want. So long story short, your content aims at doing that, which I think is awesome. Before we get into some tips and tricks and different ideas for people, what got you into doing what you're doing? What's the passion that drives you to help people with this?
So I like to bring people happiness, take away stress, and value. And when I discovered that within accounting, this will give me that outlet, I started to pursue it.
Sure, that makes sense.
Bookkeeping is another type of accounting, auditing. There's so much CFO services, fractional CFO. So I just specifically focus on the taxes because there you get to work directly with people and bring the smile to their face. You're not working with a big company that who knows who's behind it, who really appreciates, and you don't get to see the value and the appreciation. And I see that appreciation with my clients. I try to just get better at that so I can bring more value to them.
Yeah, that's all about helping people, making them happy. How do you describe your ideal client or the people that you're mostly working with? So it's small business owners, it's not the big corporation, but is it, I don't know, a business with a couple employees, or what does it typically look like?
My clients will be anywhere between businesses with employees to businesses who are just still solo or high income earners, even on W-2, who want to consider tax, savings and are willing to host the idea of starting to earn on the side 1099 and build that out. Or if it's also people who are just making 100% W-2, but they want to still take advantage of specific ideas just as a consultation, now as ongoing tax services, more like just, okay, let's figure out my maximum contribution I can put to retirement, Roth, traditional, HSA, HRA, and other methods, saving for education and emergency savings, saving for all sorts of other things, big events of life, and ours too, they need to first get out of debt, how to help them rope them out of debt first in order to, it's like, great, I'm posting about these IRA things, but let's be realistic. That's, for people who can benefit from those tax gains. I'm stuck in debt. What do I do? It's not unrelatable. So let's rope you out of the debt, get you on your feet. Then we could make this relatable to you. So I try to help people, from spectrum to spectrum. Sometimes it's just a consultation because they're not really holding in place to put in all the tax strategies. It's a consultation to help them with a roadmap out to get there, and then helping those on an ongoing basis who need that. So those people could be anywhere between on a W-2, working their way up, or starting to earn side income, to being fully self-employed on their own as a solopreneur, to being a business with employees. So I have a wide spectrum.
Yeah, there's a lot of overlap between what I do as a financial advisor and what you're doing from the tax standpoint. And we run into one of the things that you alluded to all the time, and it's balancing, I have some debt, maybe it's student loan debt, maybe it's just a mortgage, whatever it is. And also I recognize there's a savings goal of where I want to ultimately get to. And a lot of these savings strategies come with a tax benefit, right? So do I put more money into my 401k or my HSA, knowing that I'm getting some kind of tax benefit? Or should I be focused on getting the debt taken care of so that I have that financial freedom down the road? And the truth is, it's usually a combination of both. It's never all or nothing. Striking the right balance is just such a huge deal.
So I could drop a couple of nuggets right now if you want, as to like how I.
Yeah, love it. Let's do the nuggets.
Okay. So we will go over, do you have emergency savings? What is emergency savings? That would be like cost of living, could be once in a lifetime opportunity. If you're getting married and you need to buy a diamond ring, and the typical diamond ring is, let's just say, $5,000, and you'll find one for $800. That's the same thing. It's like still a once in a lifetime opportunity. Just someone who's liquidating and they got in a bad family health situation and they're just selling everything at beneath cost price or who knows. And you would say, which credit card to pull out? No, you don't want to pull out a credit card. You want to have that emergency savings because so once in a lifetime. So that's also part of emergency savings. How many months of emergency savings should you have? Should it be 1 month? So in the beginning, while a person still has debt, I would say yes, 1 month is ideal. And as they extinguish their debt, they could build these 3 months. And much later down the road, when they're already funding for retirement, they could extend that to 6 months. Also, I would prioritize other savings if they have a match in 401k match, to always give that priority no matter the situation, because it's 100% returns. So even if you're paying interest and credit cards, the 100% match is still going to be better for you. So for that, always take advantage of that. Then also working with either this, most of the times, the snowball method of getting out of debt, where you pay all the minimum payments plus more to the lowest balance. And then as you knock that out, you move up to the next one. So you have now the minimal payment plus the minimum payment that you knocked away the balance, plus that additional amount that you were throwing at that minimal payment. You roll it up, you go two, you knock them all out, one after the next. And typically you get out that double as quick as had you not done that and just randomly paying down debt. And then slowly starting to figure out where to put, right? Which usually starts with a Roth IRA, figuring out how to get the max, whether it's through directly or workarounds through the back door. And eventually, once it builds up enough of a balance, it becomes a self-directed IRA. And also to supplement that, when you have the ability to add more funds, to put the HSA. And we know that to retire comfortably, generally, you need to have 2.5 million saved aside. So, there's tables that if you put them around a certain amount every year, you'll get there.
You can do the compound interest math on it. You can figure out exactly what they need. I want to go back to your emergency savings conversation a little bit, because it's such an important part of financial planning or tax planning that gets overlooked. I think a lot of young people are guilty of, they graduate college, let's say, and they say, I got student loan debt and I know I should be saved for retirement. And those two things are enough to focus on for anybody, right? So they start hammering down the student loans and they got their 401k and they know there's a max on it. So maybe they want to get to the max on that or the Roth IRA, whatever it is, and they pass on the emergency fund. And then something happens. You mentioned the diamond ring idea. Maybe they have something happen at their house or some emergency comes up and they don't have money. And then they're calling their financial advisor. They're trying to figure it out. And they want to take a loan out of their 401k, or they're trying to borrow money from somewhere and there's a much higher interest rate and it destroys their financial plan. So I just want to emphasize how important that emergency fund is. And you mentioned it could be anywhere from 1 to 6 months. The CFP textbook, if you want to go by the textbook definition, says 3 to 6 months. I think that's a good spot to be, depending on how stable your income is. I always use the example of a realtor. So if you're a realtor and you're living check to check, you got commissions, sometimes you have a great month in the summer, winter comes in New York and it's not as good to sell real estate. Maybe that person does need 6 months of an emergency fund. Whereas if you're a W-2 employee, if you're a teacher or a nurse or somewhere where you have very stable income, it's very predictable. It's unlikely you're going to be out of work. You probably can get away with that 3-month emergency fund. But I think tying some purpose to that is important as well.
Yes, 100%. And that's important that you mentioned. I usually mention, I forgot, that part of getting out of debt is also making sure you don't go back in debt. And that's why you need to have emergency. You need it at the same time that you're getting out of debt. You must build your emergency fund, because that's your insurance that you're not going back in debt.
Sure. Absolutely. I'd like to get into some more, I don't know, advanced tax strategies, if we can
Let's
call it
go for
that.
it.
We could talk about 401ks and Roth IRAs. But people mostly understand how that stuff works. One thing that I think I saw you post about this a little while ago, and I think it's a cool idea, is if you're a 1099 employee or a 1099 self-employed person, there's ways that you can compensate your children and allow them
Yes.
to either put money into their own Roth IRA, or there's tax benefits to that. Would you walk through an example of how that works and when it makes sense?
Yes. Okay. You have to divide between kids who are under 18 and over 18. So if you have your own business and you're an S corporation or an LLC, and you have children of any age that could do any task, whether it's doing some marketing, office, organization, or any other skill, social media, you could pay them. Do you have to 1099 them or not? That's why I made the division between 18 and older. Over 18, yes. Under 18, you can get away without doing any reporting. No W-2, no 1099, nothing. You can't pay them out of a corporation necessarily, so you have to have a management Schedule C or LLC on the side where you transfer the managing fund, zero that out. Now, what do the kids use the funds for? It could be for things that allowances, like you tell them, go buy your own cell phone plan, go pay your own tuition, right? You could take that funds and they could then go and use it for the stuff that you would have otherwise had to spend on, right? But they need to do something that fairly alludes to the money that you are sending them. So if you're going to pay them 15 an hour, 20 an hour, you give them enough hours of work, such work, that you could then go ahead and pay them. So you need to make sure that your structure is set up, and there has to be a paper trail. You can't just come into tax return and say, yeah, I paid the tuition, I paid the phone bills, fine, let's go pull that off of my personal bank statement and add that up. And let's go ahead and do that Schedule C thing. We'll create the LLC. It wouldn't stand in the audit. You need to have that paper trail. So you need to have that separate bank account, and throughout the year, you got to make those transfers. You got to go like a lily pad from the business bank to that bank to your personal bank, paying. You got to leave that paper trail. And when you have that paper trail, then you show you didn't pay them out of the S corporation, because that's going to be issues as a DOL. You put it into the LLC or the Schedule C bank account, and then you pay them out from there.
Let's say,
And,
can I just paint the picture for a second? So I want to have an example client so it all makes sense. Let's say I'm a W-2 employee, but I've got a side hustle. I make 10 grand a year selling trinkets, whatever it is. That comes to me as a self-employed person. I have a child that is 10 years old, we'll say. Can I turn around and pay my child $7,000 a year so the child has $7,000 of earned income and can take that earned income and max out a Roth IRA every year? Can my 9-year-old or 10-year-old do that?
So you could open up an IRA for a child. It's usually not tier one. Like the tier one would be putting on your mask before putting on someone else's mask, which means you want to first fund well your IRA. You could still pay them whether they do open up their own IRA or not. The question is also how much. You mentioned 10K as an example. When I put expenses to lower income on the business or on the side hustle and all that, I take very much into consideration how much of an expense, what that ratio is compared to the total incomes.
Right. It's got to be reasonable compensation.
Has to be that reasonable compensation is how much for an S corp you take for as a salary, but the expense has to make sense. Is it if you're telling me taking travel over a certain percent, or meals or supplies to make that, so on every tax return you got to put an industry code and live an algorithm as to, from all the people filing that industry code, what expenses are common in that industry and what's not. So if you tell me as an Uber driver industry who's self-employed, there's a lot of car maintenance, I would believe that. And you'll see that across all the Schedule Cs. Imagine all of a sudden there's not too much car expenses, there's mainly advertising expenses. That's a little bit of a red flag. For someone else, advertising expenses will make sense.
If you're an Uber driver, you can't pay your 10-year-old a salary to be a spokesperson
no.
for your Uber business.
You can say your kid comes every day and cleans the car for you. Your 10-year-old goes, picks out under the seats all the trash and figure out something, or once a week, whatever it is, and it takes him this amount of hours. As long as you make some reasonable, scenario going on, and you're sticking to it, then you can go ahead and pay your kid. Yes. Would it be 7,000? Would it be more or less? It has to be under the standard deduction if you don't want them to have to file their own taxes. The federal standard deduction in 24 was 14,600. And on the state level, every state is different. Some piggyback off of the federal. New York, for example, is 8,000. So you want to pay them under 8,000 if you don't want them to file a New York State tax return. So that's just something to keep into consideration as well.
Okay. Yeah, that makes sense. So as a blanket rule of thumb, which is really hard to do in the tax world, right? It might make sense to pay your child in New York State up to $8,000 as reasonable compensation for services that make sense in the context of your business.
Correct. Correct. Yes. I do it for many of my clients. I help them figure this out, the trail, the paper trail, make sure that what they're doing is reasonable, because you could read up a whole bunch of ideas online. And my posts are very hand-holding. They give you a lot of details that technically, if you were an accountant, you could take it and run with it. But if you're not an accountant, you feel the value in it, but you're skeptical how I would employ it in my situation. Because if you're not doing the tax returns and keeping ratios and analytics in mind as to how much you're using of that expense, and do you have the paper trail to back it up, it's a little bit, people shy away from it, from doing it. Yeah.
Sure. Yeah, that makes a lot of sense. And for anyone listening to this, the posts are awesome. Go read them. They give you a lot of ideas on what you can and can't do. And of course, it's only so much information. So reaching out to an expert like yourself is extremely valuable as well. So they can give you more hand holding through it. I want to talk about a couple other ideas too. And I don't know if you have some specifics. Was there anything that you wanted to cover specifically you think people should know?
Yeah, that it's important to be in touch. If you have an accountant and tax expert that you work with, to be in touch with them, at least in the last 2 months of the year, where you have 10 months of solid data, and you can forecast the last 2 months and see if there's anything that you could do to do better for the upcoming year. Because if you don't do that tax planning, once January hits, it's already too late to do and leave a paper trail. If you want to leave a paper trail, it's got to be done in the year of, not the year after.
Sure. That's why we do. So our review meetings, we meet with our clients twice a year. We meet in the spring around when taxes are due. Not because I don't file taxes, but it's a good time to get in front of the client. All this financial stuff is on their mind. They just went through this with their CPA, and there's some adjustments we can make going forward into the year. And then our second meeting of the year is always October or November, because just like you said, we want to have 10 or 11 months of solid data so we can make decisions that matter for December 31st. Do we want to do a Roth conversion? Should there be tax loss harvesting? And as there's several things that we want to do, and I like to make the joke every time that I don't want to be chasing my clients around on Christmas Eve asking them to do their Roth conversion. So we want to meet in October and have some time to plan. So I think it's awesome to take the same approach. Another topic I thought we might cover, and this is one that I think it's confusing for business owners, is you started a business, you recognize that you want to save for retirement, you no longer have that 401k plan from your W-2 job. So it now becomes, what's the best way for a business owner to save for retirement? And they have a lot of choices. So when they go on Google and they search retirement plans for business owners, they get everything from the solo 401k to the SEP IRA, the simple IRA, just using a traditional IRA, using a Roth. Should they use just a brokerage account? There's a million different ways they can do this. What is your approach to that of maybe we start with this option and progress down based on different factors? How do you approach that?
Yes. So all these different ways of savings are created for a purpose, right? It's not that one way is bad and one way is not good, right? I was speaking to someone a few days ago, and they told me that they were watching a clip how somebody built a lot of wealth based on IULs. It's like a life insurance where you build like whole life or something. I told them, great. That's for somebody who already have 5 million in the Roth. It's not bad. They're not wrong. It's for the right person. And the same thing is for money market saving accounts or typical saving accounts. And the same thing is for brokerage accounts. It's all for the right situation. Like the emergency savings, I would say that in a money market account where you're earning more than typical interest than just a regular savings account, a couple more percent, the limitation is how many times you can transfer in and out and keeping a balance. And with brokerage accounts as well, if you're saving for a retirement account, for a down payment or some large wedding or occasion or school or something that you want to pay up in the upcoming years, you may want to save it to gain a little bit extra interest in the meantime. And for saving for retirements, and you're out there on your own, I would start with a solo 401k, figure out how to get that set up for yourself, which means to say you have to have your own situation and go out and set that up with an expert who sets those up. And then there's going to be limitations of how much you could contribute, right? Whether you could contribute up to 25% of your payroll, and then there's additional amounts you could contribute as after tax contribution. You can also open up on the side of your job solo 401k, another IRA, Roth IRA, put in another 7,000 or so. And if you're married and you have your spouse, you can also kick out to them a W-2 and double your efforts of how much you could put away. And cumulatively, you could end up putting away up to 100K if that's where you're holding. But even if not, at least you'll still be putting in a lot. Like that's one way of saving up and most advisable, I would suggest, versus doing life insurance and other methods.
I was just saying, life insurance, there's a lot of people in that camp that push it very hard, the cash value life insurance. I'm not one of them. I think that, like you said, every account has a purpose. There's no such thing as a bad account or but there's no such thing as a bad tool. It's how you're using that tool. So we do see, unfortunately, a lot of people get sucked into doing the cash value life insurance when you're right. They should be maxing out the Roth, maxing out the 401k. There's all these other instruments they should be using before they get to that. And then, yeah, if you've got, I think you said $5 million already in a Roth IRA and you got to put money somewhere else, starts to make sense.
And the different accounts have different strings attached to them. Like with life insurance, there's premiums you got to live up to. Roth IRA, there is no premiums. You can't do 1 year, no problem. There's no demands that you must put in. And they're different vehicles, meaning to say you could put in your backseat and trunk what you want, right? So with a Roth IRA, you could self-direct. You could invest in real estate. Imagine you've been saving, and you hit 40 years old and you have $1 million or so in your retirement, and boom, your nephew or your niece shows up and they tell you about they're just entering the workforce in their early 20s and they want to go ahead and buy a building somewhere and rental, and they want to give you 50% ownership in it for if you give them 200K investment. Now, you don't have a typical savings account. All you got is your retirement. You could take that retirement amount and through there, invest into their, be that rich aunt or uncle by self-directing it, and all the gains and losses have to roll back into the retirement solo for in the self-directed IRA. That is another cool perk about doing that. And like I said, you could decide what you're invested in. You don't must invest in what they tell you to, like whether it's the S&P 500 or whatever portfolio they advise you to. Now, I don't tell my clients where to invest into. I just ensure that they're aware that they could be on top of it, or speak to somebody who wants to flip through all their investments and tell them move more here, take away from there, and all that.
Yeah, absolutely. You're looking at it from a tax standpoint, not necessarily the investment level, but I think for financial planning in general, I like to be an advocate for building flexibility. And anytime you get into a type of account or a product where there's mandatory premiums or things are locked in, or there's a surrender charge where you can't touch your money for X amount of years, that makes me nervous. I want my clients to have as much flexibility as possible in their plan, and having liquid assets, having assets that you can invest in different areas when opportunities pop up, I think is extremely important.
Yeah.
Correct. So another scenario we run into, and I don't know if you'll have a lot of advice around this, but you get to the career progression of a person when they're young, starting out, and in their middle ages, even there's a lot of opportunity for tax savings. You have mortgage interest you can deduct, you got child tax credits, you had all those kinds of things. And then later in life, maybe you're 60 years old, you're still working, your kids are out of the house, you don't have the mortgage anymore. It seems like you get beat up on taxes a little bit. You don't have all the same opportunities. What are some things that person can be doing to lessen their tax burden today, or maybe even to set themselves up for less taxes in the future?
Very good. So that's where also paying your grandkids, nieces and nephews come into play. Mm-hmm. Right? Passing down the generational wealth tax free. That's also another, it's easier to save money than it is to make money. And it's easier to have your Roth IRA work for you than you going out there and work. So in the younger years, when you're generating that income and taking tax strategy, if you fund everything into a Roth IRA, it goes tax-free. And you live on the gains tax-free. So once you eventually hit the age that you can start withdrawing, you will have tax-free income that grows. So even if you're not peeling away at the principal, you're just taking away, you're not taking away the capital, you're taking away the gains. Meaning to say the gains are tax-free. So that is one way of doing it, by saving and putting away so that it grows tax-free. And also taking this tax strategy as paying your grandkids and nieces and nephews. Another thing would be is if a person is more middle class, right? In my term, when I'm telling you middle class to high class, it would be like, if you're in a structure that you have passive income, passed down generational wealth, and you already know that the rest of your life, you don't really have to work. You just work because you like to be productive. You don't want to be rotting away. The extra income is good. Why not? Add to the generational wealth. And you can always be in the 37% tax bracket anyway. Then whenever you can put it into an IRA, always put it directly into a Roth, because you're never going to have that moment where you'll be in the lower tax bracket, right? Now, if you are middle class, meaning to say now you're in a high peak earnings, you're making $500,000, you're making 300K, 600K, you're in the 37% tax bracket. To go and do a Roth IRA means you got to pay 37%. Now, every couple of years or several years, you create a small bump, whether you're finding a new job or whatever, and you jump down to 20%, 22% or less taxes. So that middle class person doesn't have that generational wealth to rely on the side. So right now, they bump down to a 20% or so. They should, when they put into an IRA, they should do traditional, get that tax deduction then, and convert in that transition moment. But they should save for the tax burden when they need to transition. They shouldn't milk it out of their IRA, because then there'll be penalties. They should save up on the side, whether it's their general savings, emergency savings. They should save up to have that funds available. Pay the tax.
Well, it goes back to what we were talking about earlier about the value of having cash. And in this situation, maybe it's having cash that you can live off. So you're in a lower tax bracket, and now you can take advantage of that Roth conversion. You convert it over even 22%, rather than already having high income because you're pulling money out to live on because you don't have anything in the bank. And now you're in a situation where that Roth conversion, or maybe even just a distribution, is not as advantageous. There's a lot that goes into that.
Yeah. And there's many things that can come up as well for people in that stage of life, whether it's, should we give up our home so that we don't have to give it into get a Medicaid or a Medicare, right? If a person wants to get a Medicare and they have a home, the question if the home is protected or not. Should they put it in the trust to separate it? Some people do that, right? Some people think they'll sell it to their kids.
Yeah, just did a estate planning episode last week. We had an attorney come on and covered a lot of what you're talking about. Is the question we get a lot is, how do I keep the nursing home from taking my house, or how do I protect my assets for my kids? And there's a lot you can do with trust. There's a lot you can do to make sure that you qualify for different things through Medicaid. It was a fun conversation.
And then there's also the reverse mortgage, if you've heard of that.
I have, yeah.
Where basically the bank lets you live in your house, but they basically bought it back from you, and they're going to give you, as long as you live in the house for the next 20 years or so, I'm not sure, there's different limitations. They give you back monthly amounts or a one lump sum amount, and you can live in there. But once you move out, the bank takes the home. So that's also something that, for the right person, if a person is single, or they're not, or they already have so much other assets going on, and this is the fair trade to do that. So it's all for the right person.
Your kids might not like it when you die. It's a
right.
awakening in the funeral to find out your parents did that.
So if that's the only inheritance or a big chunk of it, then definitely you want to take into consideration passing down a generational wealth, right? As I mentioned, some of these single, meaning to say that they don't have somebody to pass it along to. They want to just live a good rest of their life with some extra cash. then they could do that. There's also putting it into a charitable remainder trust. That's another thing people do, where somebody who's also doesn't have those to inherit their property, but they want to give it to a nonprofit cause and start living already now during their lifetime off of the capital gains tax free. They put it into a charitable remainder trust. That's another thing people do at that stage of life. It's another consideration.
Yeah, there's so many options. We could talk about charitable remainder trust, QCDs even for hours. So one more theme I want to touch on before we go here. We're getting to the end of our time. And I've seen you talk about this a little bit. I talk about it all the time. And that's the HSA. It's interesting to me. I meet with a lot of individuals, sometimes younger people, and they have an HSA and they're contributing to it. And they're just picking an arbitrary number. They're just putting $100 a month into their HSA. And it frustrates me. To me, the HSA is the biggest tax savings opportunity that's just presented to you as a young person or anybody that's working really. To me, everyone should be maxing out their HSA. I can't think of a reason why they shouldn't. First of all, do you share that belief? And if not, let's have a conversation about it.
This is how I approach these types of savings. Is you should divide your income like this. You live on 70%, and you take the other 30% and divide it into groups of 10. 10% you put long-term saving, which include HSA and Roth IRAs, IULs, life insurance, anything that's long-term. 10%. 10% for your emergency savings or short-term savings, like whether it's up to 6 months of emergency, other large spending coming down the pipeline, like weddings or whatnot. I'm buying a new car. It's better to save for it than to go into getting an auto loan, right? The car is an expense, not an investment. House is an investment, right? For any large purchase coming down the pipeline, you want to save for it, not go into debt for it. So you want to have 10% for that, because every year or 2 years is going to be one of those large purchases. And 10% to those who want to give charity.
Yeah, that's awesome. Definitely want to support charities. I think that's a cool way to set it up. I guess, the HSA conversation, I get fixated on just the tax benefit that's there. And for it to go in tax-free, grow tax-free, and if you use it correctly, be used tax-free, is such a nice opportunity. And the maximum limits are not that high. I think it's something that everybody can strive for, maxing out their HSA. I would even advocate for lowering your other contributions, save less into your Roth or your 401k. You want to still get your match, and I think you can max out the Roth also. But to me, the HSA is awesome. I think people should be all over it.
Yeah, I definitely agree. I'm not such a fine-tuned expert as to say, like, I could choose to only max one, but not the other. Tell me the right dollar ratio, what to put here or there. I don't really step into that territory. Like, I will bring to your attention that they're both great options, tier one options, and then I'll leave someone up to you or someone else who wants to get into the nitty-gritty details as to where to invest it or how much ratio to put into that. Like I will, in advisory calls, consultations, I will help my clients figure out what the right method is, the roadmap is out of debt, and then how to save up for the 10% for the short-term saving to the 10% of there, and what's the right general approach. But as far as to which one is better or not, I don't really get too much into that details, because they both have great stuff to it, and you're all over the HSA, so I will agree with you that it's great.
I appreciate the vote of confidence there. Cool. We are getting to the end of our time. First of all, thank you for coming on. This is awesome. I think there's some great content in here that I'm excited to share with people. Anything you want to leave us with before we call it quits?
Yes, anybody who is looking to do their best on not overpaying in taxes and fixing up their situation, whether it's getting out of debt, setting up the right corporate structure so that they're set up for success, whether it's paying the least in taxes or maintaining your privacy and legal protection, to be in touch, to leave my contact information.
Absolutely. We'll have your contact information in the show notes. What's the best way to follow you? So I know you're on LinkedIn. Anywhere else people can go find you?
So my website is about to be launched.
Okay.
Yeah, it's eilenbergcpa.com. And my email is team@eilenbergcpa.com.
Okay, awesome. We'll have it in the show notes so people can reach out, and we'll go from there. So thank you for coming on. This is where we're going to call it quits. There's no good way to end a podcast, so we're just going to cut it right here. We're done.
Appreciate it. Thanks. Okay.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Alexander Neri. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Alexander Neri or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Alexander Neri and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.